Hi everyone, Tony Talks Money here with my money tree picture behind me. I've been a financial advisor for over 30 years. I run my own business and I've invested with a long-term mindset my entire career. Every week I help people just like you make smarter decisions with their money. Let's talk about what really works today. What if I told you that you don't need to be rich to become wealthy and that the world's best investors all use the same method? One that's available to you right now. Here it is. Invest in shares, hold them, and be patient. That's it. Let's look at the legend himself, Warren Buffett. At 94, he's finally stepping down as chairman of Berkshire Hathaway after more than 50 years in the position. He's given away lots of money to charity, millions, and he's still one of the world's wealthiest people. How did he do it? By investing in shares patiently, sensibly, and for the long term. Here's the real secret. Patience isn't just a virtue in investing. It's your superpower. All the research I've seen over decades comes to the same conclusion. Shares, otherwise known as equities, are the best way to grow wealth over time. Yes, crypto's exciting, but it's very volatile and very speculative. Shares remain king. But here's the catch. You must invest for the long term. And by the long term, I mean at least 10 years, preferably 20. This is one of my all-time favourite charts here. I use it all the time and I'll keep using it because it provides a valuable reminder that the long run is your friend as an investor. The longer you stay invested in the stock market, the better your odds of making a profit, rising from just 51% over one day to a perfect 100% over 20 years. Everyone needs those reminders because the short term is up in your face all the time. Thinking and acting for the long term works. But it's important to understand that the longer your time horizon, the higher the probability you'll experience big losses too. It shows that the longer you stay invested, the better your chances of serious wealth creation. Fun fact, nearly all of Buffett's $100 billion fortune came when? After he turned 65. Another thing you need to remember, don't put all your eggs in one basket. If you're picking your own shares, aim for at least 10 different companies. Even better, use a few low-cost index tracker or ETF fund. Can't name any particularly, but they're there if you do your own research on Google. Let the professionals do the heavy lifting while you focus on life. Diversify across sections and industries. That's how you reduce risk and ride out the bumps. Now here's one of my favourite stories, one of Ronald Read, a janitor and gas station worker from Vermont. Never earned very much, lived very simply, but he invested in blue chip stocks, dividend paying shares for decades, quietly. When he passed away, he left $8 million to his local library and hospital. Lesson, it's not about how much you earn, it's about how much you save and how you invest. And that means practicing deferred gratification. Buffett did it, Ronald Read did it, and you can too. But don't go overboard. Still enjoy your life. It's about finding a balance between spending and saving. As the old saying goes, we buy things we don't need with money we don't have to impress people we don't even like. Let's not fall into that trap. Crazy, isn't it? Let's talk about selling. Don't sell unless you absolutely have to. One of the biggest investing mistakes, selling too soon out of fear. You know, a lot of people think they can time the market, buy low, sell high. But the reality is it usually ends up costing more than it helps. First off, there are the obvious costs like trading fees and the bid-offer spread on the price of shares, which can really add up over time, especially if you're trading often. Even if your broker doesn't charge commissions, every trade still has hidden costs. Then use your time. If you're spending hours each week trying to analyse the market and make the right moves, that's time you could have used elsewhere. And honestly, it really pays off. But the biggest cost, sitting in cash, waiting for the perfect moment. That means you're missing out on potential gains. And here's the kicker. Most of the market's returns come from just a handful of really good days. Miss those and your total return can drop by half or more. If you look at this chart, you will see that just missing the top 10 days in the market over 20 years can massively reduce your returns. So instead of trying to time, typically staying invested usually works out better in the long run. Here's the final piece, and it might surprise you. Investing is more about psychology than intellect. You don't need a PhD. You need emotional discipline. As Warren Buffett has said, be greedy when others are fearful and be fearful when others are greedy. And remember the old Baron Rothschild's quote, the time to buy is when there's blood in the streets, literally, either stock market crashing or wars going on. So if you want to build real wealth over time, invest in shares, be patient, diversify, control your emotions. It's not flashy, it's not quick, but it works. And you know what? You know it makes sense.